Hey, what's up, my friend? So in today's training, I want to share with you the 3 golden rules, right, when it comes to trading chart patterns. So let's get started. Number 1, the longer it ranges, the harder it breaks. So what do I mean by this? So let me explain. So let's say you see two charts, right? Let's say this one is this market is in a range, right? And let's say this range is about 20 bars. Okay, from left to right is about 20 bars. And then you notice another market which is also in a range, but this time around the range is 80 bars. Okay, so you can see that in this case, right, this market is ranging for a longer period of time compared to this one over here. So now, given these two choices, which one do you want to trade the breakout? So chances are you want to be trading this type of market condition where the range has been in a sustained period of time. Why is that? 2 reasons for it. Number 1, when the market is in a sustained period of range, okay, what happens is that this highs and lows of the market will be obvious, right, to more participants in the market. Traders on a 5 minutes time frame, the 1 hour time frame, the daily time frame, they will be aware of these boundaries in the market because the market has been ranging for such a long period of time. Traders across different time frames, they will pay attention to it and it's more significant. Number 2 is this: when the market is in a range for a long period of time, what happens is that a cluster of stop orders, right, will be built, right, just beyond the ends of the range. So let me explain. So imagine, right, if someone will to, let's say, market is at the low of this range and it bounces up higher, someone goes long because thinking that support will hold. So if you are long at support, where will you put your stop loss? Well, chances are you put your stop loss below the low of support somewhere over here. So you can see that market, bounce up and down off support number of times, right? Once, twice, 3 times, 4 times. So when many traders spot this, right, they will look to buy at support, and a lot of them would place their stop loss below the lows of support. So same reason, right, at the highs of the range, when traders notice the price bouncing off resistance, they go short. Where would they set their stop loss? Chances are above the highs of resistance. So when this goes on for a long period of time, right, the cluster of stop orders get built more and more over time. And when the price eventually, let's say, breaks out and hits this cluster of stop orders, what happens? If you think about this, right, if someone who is short this market, okay, and if the market hits their stop loss, that is actually a buy order to get out of their short trade. So this cluster of buy orders, right, will propel and push the price up higher. And that's not all, because if a breakout trader who spot the market breaking out of resistance, he looks to buy as well, this will fuel, right, even more momentum to push the price up higher. So this is why the longer it range, the harder it breaks. Okay, so if you're trading reversal chart patterns like the triple bottom, double top, etc., pay attention to this principle. Number 2, reversal patterns can also be trend continuation patterns. So for example, reversal chart patterns like the inverse head and shoulders pattern, right? Reversal patterns like the double bottom, right? But this, right, doesn't have to only be reversal patterns, because they can also be trend continuation patterns. So let me give you an example. So let's say the market is trending up higher, okay? You might get a inverse head and shoulders pattern like this. Now this is bullish, right? Because this is a sign of strength, because this tells you that the sellers try to take the price down lower, right? We have this, the seller pushed the price lower, made this swing low, then you have another lower low. But then they tried to push the price higher for a third time, but they couldn't exceed this low. In fact, the price then bounced up higher, right? Reaching back towards this swing high, this neckline. Okay, so you can see it over here. This is an inverse head and shoulders pattern. This tells you, right, that the sellers tried to drive the price down lower 3 times, right, but the third attempt, right, was even weaker than the second. So this is a sign of strength. So this means, right, if the price does break out higher, okay, this can be a trend continuation pattern, even though, right, this by right, it's a reversal pattern. But if you take into context, right, of reading it with the trend, right, you realize that this can also be a trend continuation pattern. Does it make sense? Okay, so reversal patterns like the inverse head and shoulders pattern, the triple bottom, the double top, etc., they all can be trend continuation patterns. But the key difference here, right, between a reversal pattern and trend continuation pattern is that this one here, right, the number of bars that it takes to form, usually you can't expect it to be very long. Usually about 25 to 40 bars. That's about it, right? It won't take like 100 or 150 candles to form, because this is not a reversal pattern, this is a trend continuation pattern. So usually the number of bars that it takes to form, right, is usually much lesser, around 25, 30, 40 bars. Okay, and finally, the last one is trade in the direction of the trend, especially when you're trading trend continuation patterns like, the bull flag, the bear flag, etc. Trade in the direction of the trend. The last thing that you want to do is that, let's say the market is in a downtrend, and then you spot a bull flag like this, right? And you want to trade a bull flag. Let me ask you, is that a high probability trading setup? Unlikely, right? Because look at this, right? Look left, you're actually trading against the direction of the trend. So yes, you have a valid bull flag pattern over here, but you're trading against the long-term trend. So what are the odds of that working out? If you ask me, right, a better approach is to actually trade the trend continuation pattern, like the bull flag pattern, in the direction of the trend. So let's say market is in range, goes up, it breaks out, uptrend, trade this bull flag pattern, right? Do you see the difference now? Now you're trading in the direction of the trend, not against it. So if you're trading trend continuation patterns, remember, you want to trade it in the direction of the trend, not against it. So let's do a quick recap, right? Number one, the longer it range, the harder it breaks. This applies to, reversal chart patterns. Number two, reversal chart patterns can also be trend continuation patterns, but they usually take less time to form, maybe, 25, 30, 40 bars. That's about it. And finally, you want to trade in the direction of the trend, especially when you're trading trend continuation patterns. Don't trade against the trend. And by the way, if you want to learn more about such trading strategies and techniques, right, you can get a copy of this book called Price Action Trading Secrets. This is about a 140-page full color trading book where you'll learn more about price action trading, support resistance, candlestick patterns, and much more. So I'll put the link somewhere below this video. You can check it out, right? And with that said, I wish you good luck, good trading. I will talk to you soon.